Chapter 5. The Key to Success, Dividend Growth. The very attention we place on rising dividends put us squarely in the position of owners of a company of true investors who understand that a satisfying and reasonable return from a stock investment isn't a gift of the market or luck or the consequence of listening to some market maven, but it is the logical and inevitable result of investing in a company that is actually doing well enough in the real world to both pay dividends and to increase them on a regular basis. Lowell Miller. Now you understand the basic mechanics of how an investment makes you money. Now let's get into the specifics about dividend growth investing and why it's such a powerful strategy. Coca-Cola, a real-life example. Let's assume you have $1,000 to invest today, and you decide to buy shares of a high-quality dividend-paying company like Coca-Cola. You know what Coca-Cola does, right? They make sugary soda water with lots of chemicals in it, aka Coca-Cola. You might have heard of it. If you're one of those organic, sugar-free types, you're still funding Coca-Cola's profits. They also make Dasani water, Simply Orange, Vitamin Water, Smart Water, Fuse, and Honest Tea. Coca-Cola makes a lot of stuff, but most of all, they make money, and a lot of it. Coca-Cola made $7.6 billion of profit in 2015, of which they paid out $5.9 billion in dividends. Dividends aren't anything new to the company either. They have paid and increased their dividend for 53 consecutive years. If you aren't excited about that yet, you will be. Back to you and your $1,000 investment. Coca-Cola currently trades for about $40 per share. That means your $1,000 would be enough to buy 25 shares. You now own a part, a very small one, in Coca-Cola's business. Congratulations. Now the fun part begins. Coca-Cola's current dividend is 33 cents per share. Since you own 25 shares, you'll get $8.25 paid to your bank account every 3 months. So your first year of owning Coca-Cola will produce about $33 in dividends. You made a return of 3.3% in year number 1 as a percent of your initial investment. I know, you're not impressed. Keep listening. Remember that Coca-Cola has not only paid a dividend for 53 consecutive years, they've increased it for 53 consecutive years. There's a big difference. Let's assume Coca-Cola keeps selling sugar water in the future. They keep making more money and continue raising their dividend for the next 20 years. By how much? They've grown it by 8.5% per year over the past 10 years, so we'll estimate 6% per year. The chart on the attached PDF shows how your dividend payments would grow over time. By year number 20, you would be collecting $99 per year in dividend income, triple your original amount. If you add all 20 years of dividend payments together, it would add up to $1,214. That's even more than your initial investment. Do you see what that means? If you buy a share of a company that pays a starting dividend yield of 3.3%, and the dividend grows by 6% per year, you can't lose money. The dividend income alone exceeds your original $1,000 investment. Even if Coca-Cola's stock price dropped from $40 to $0, you would not lose a dime. Dividend payments get paid to you regardless of what happens to the market value of your shares. I can't stress that enough. Dividends get paid regardless of what happens to stock prices. Coca-Cola's stock price could fluctuate from today's price of $40 down to $30. Most investors would freak out. The market value was $1,000 and now it's $750. Panic! Sell, sell, sell! Then the stock price goes up to $50. Buy, buy, buy! Then back down to $35 and the panic starts all over again. As a dividend investor, you don't care about Coca-Cola's stock price. It doesn't matter. That 33-cent dividend is still coming in 3 months, and 3 months from then, and 3 months from then. Let's see what would happen to Coca-Cola's stock price under various different price scenarios. What would happen to Coca-Cola's stock price? Back to you and your 25 shares of Coca-Cola. Coca-Cola's dividend continues to grow by 6% per year. Remember your measly 33 cents per share in dividend income? Yeah, that's going to be a lot higher. After 20 years, Coca-Cola's dividend per share would increase from $1.32 per year to $4 per year. What would the stock price be worth in 20 years? We can't know for sure. However, we can know it will likely be much higher than the $40 it currently trades at. To prove that out, let's assume for a second that Coca-Cola's stock price stays at $40 for 20 years in a row. In 20 years, Coca-Cola would be paying $4 per share. That means another investor could buy and make 10% per year from dividends alone. Other people would see that 10% yield and start to drool. A virtual guaranteed 10% return in one of the best companies on earth is a great investment. Investors would fall all over themselves trying to buy some shares. All the buying would push the price of Coca-Cola's stock higher. How high? We don't know for sure. We do know that Coca-Cola's price will go up enough that the $4 dividend is a more reasonable initial return. A quality company should never have a dividend yield of 10%. It is an obvious buy at that level. So what should the dividend yield be to make it more reasonable? The table on the attached PDF shows what Coca-Cola's $4 dividend looks like at various prices. At $40, the initial dividend of $4 would be a 10% yield. At $50, the 4% dividend would be an 8% yield. At $67, the $4 dividend would be a 6% initial yield. At $80, the $4 dividend would be a 5% initial yield. And at $133, $4 would be an initial yield of 3%. Which of these initial yields is low enough that investors would start drooling? To answer that question, we can look back at history to see what Coca-Cola's yield has been in years past. In March 2009, Coca-Cola paid 84 cents per share in dividends. You could buy a share for $22, which made the initial yield 3.8%. That's about as high as Coca-Cola's initial dividend yield has been in quite some time. In May of 2013, Coca-Cola's initial yield got as low as 2.5%. If we use this as our guide, we conclude that Coca-Cola's dividend yield is likely to stay somewhere between 2.5% and 4%. If it pays a $4 dividend in 20 years, we can calculate its estimated stock price. We divide the dividend, 4%, by estimated yield. At a 4% yield, the stock price in 20 years would be $100. At a 2.5% yield, the stock price would be $160. Do you see what's happening here? As Coca-Cola's dividend grows, its stock price is moving with it. The dividend acts like gravity. The stock price can go up in the short term, but it can't go up forever. The same with the downside. The stock price can go down in the short term, but it can't go down forever. The dividend payment becomes too enticing, and the stock price must rise to keep pace. This is a key point. A growing dividend puts upward pressure on a stock's price. Over a long enough period, it's impossible for the price not to grow with the dividend. You are starting to see the power of dividends. There is still something we haven't considered: dividend reinvestment.